Fundstrat's head of research, a CNBC contributor. He, of course, also the chairman of BitMine. So it's good to have you. Ether's down 8.5% this week. Bitcoin's down 8. BitMine is down 20. What's happening here?
Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. You know, it was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. You know, every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Can crypto treasuries, like yours, for example, can they trade as well or in tandem with a cryptocurrency itself, or does one have to trade at the expense of the other? If I'm going to see money flow into Bitcoin or crypto treasuries, wouldn't it then come out of the actual pure play coin itself? Not exactly, Scott. For instance, when BitMine has shareholders and institutional capital comes in, and you know JP Morgan, Invesco, BlackRock are buying big stakes, then that capital is then used to buy Ethereum. So it's actually going back into the ecosystem, but then it's going into a vehicle like BitMine that's actually a permanent holder. You know, BitMine owns 3.5 million Ethereum, more than 2.9% of the supply, but now that is not going to be subject to liquidations because there's no leverage used to hold that Ethereum. And then at some point, that 3.6 million or 3.5 million Ethereum is going to be staked and then generate, you know, nearly $400 million in net income. Well, that can create returns for shareholders. So in a way, a crypto treasury is actually a pretty attractive equity because there's a, you know, an income component plus there's, of course, that ability to grow your Ethereum holdings per share. But what if crypto treasuries become more favored than crypto itself? There's no negative impact for either the way that Ether or Bitcoin would trade if just more money floods towards the treasury part of this story? Well, one, it's a conduit because, as you know, equity managers, many of them, the 4,000, can't own crypto directly. So they have to get exposure to Ethereum by buying a stock like BitMine. And BitMine is the 438th largest stock in America today. It's not that different than if someone wanted to have exposure to energy, they can buy oil and trade a commodity, or they can take like oil barrels at home, or they can buy an oil-related stock, you know, either a major or something in the supply chain. That's what crypto treasuries are, is essentially an asset class that gives you direct exposure to the crypto asset. All right, let's pivot to the market itself. Is your confidence at all shaken in where we are and what you thought the prospects for an end-of-year run could be after what we've seen this week? Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. But it is consistent with the idea that, you know, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAI went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. You know, in fact, maybe over 7,000 by the end of the month.
New information hitting the tape. We've got business inventories, consumer confidence, pending home sales. Pick your adventure, KG. What are you seeing out there?
Yeah, a lot of data. I mean, 2 weeks ago, we were kind of begging for this data, and today we have way too much of it, it seems like, Sam. We are looking at pending home sales actually coming in a lot better than the Street's expectations, coming in at 1.9% for the month of October. Street was looking for around an increase of 0.5% on a month-over-month basis, and previously that was actually revised higher to 0.1%. So a really strong number when it comes to pending home sales. We've talked about the mortgage rates kind of moving to the downside here. Prices also kind of leveling out. We had some pricing data early on today. that also signified that, and maybe some buyers are now stepping out off the sidelines, trying to get into these markets. What's also very interesting about the home market in general, you're starting to see a significant amount of cancellations as well from these buyers. Now, that doesn't mean that they're not buying homes, but it just means that there's a lot that they can choose from, and that's a signal that inventory is actually increasing here. We have the Richmond Fed number also coming out. That came in at -15. Street was looking for -5 when it comes to the Richmond Fed. And I think the other focus area that we've been kind of talking about has been the retail sales number. I would say for the most part, it's actually mixed to probably a little bit better when it comes to setting up the rate cut expectations. If you're looking at the month-over-month print, now this is for September for headline retail sales, that came in at a growth of 0.2%. Street was looking for 0.4%, so missing the Street's expectations there. But if you're looking at the retail control group, that's going to be a very big component, something that we don't talk about that much. Think about that as like the core PCE number of retail sales, if you will. That actually came in at -0.1% on a month-over-month basis. And the reason why I'm highlighting that is that's going to have a direct impact not only for PCE prices as well as the GDP as well. So we probably will see a revision to the downside from the Atlanta Fed GDP Now forecast, which could lead a little bit more confidence for some of these members that are on the fence about a 25 basis point rate cut in December. So a lot of data for today. We're obviously digesting this as well as other news items here, and that's why we are seeing a lot of gyration in the market, especially if you're looking at the S&P 500.
Yeah, I mean, a lot of information, as you say, a lot of data to chew on this morning. Of course, some of it backwards looking, a little bit stale, but it's very important as far as confirming the trend that we've been seeing, and particularly as it feeds into the Fed's calculus come that December rate cut. I mean, the odds have jumped to about 80%, and no doubt this has been helped by some of the dovish commentary coming from the likes of Daly, Waller, Williams. We've had Besson out this morning making some very interesting comments about how he thinks that the Fed should be fading into the background a little bit more and calm things down and work for the people. So make what you want of those comments. But what do you make of the reaction in the markets today? I mean, the 10-year coming off, and so is the dollar. And obviously, we are tracking what's going on in equities as well. A little bit of a softer picture than we saw yesterday. What's your read on it all?
Yeah, so what I would focus on here for the S&P 500, I think looking at the Nvidia story, and it's really important right now, if we could actually bring up a 1-minute chart of S&P 500, a very interesting development taking place. Nvidia is now below that 170 level. That has been a key area of support that we've been looking at since September of this year. So you are seeing aggressive selling taking place. Nvidia is down about 7%, and the S&P 500 just dropped about 30 points or so from this 60, about 30 points or so. So a lot of volatility that's actually taking place holistically for the market. Keep your eye out on volatility. Volatility is edging up here a tad bit. Now we're sitting at around 21.27. And from a technical standpoint, Sam, we did have a nice rally yesterday. We saw a broad-based participation, but unfortunately, we did also stop a little bit short from that 50-day moving average for the S&P, a very key area for technicians that are out there. And if we fail that today and we see a pullback to the downside, that could give bears a little bit more confidence that they can knock this market down, given the events that we have, this rotation between TPUs and GPUs and maybe concerns about demand in the future. That's really what's being priced in right now in this market.
Yeah, absolutely, particularly off the back of Meta using the Google AI chips. That seems to be what is weighing on Nvidia right now. No doubt, obviously, we saw yesterday Google charging ahead and really powering the NASDAQ to its best day since May. And a lot of the conversation had been really centered around whether leadership is changing, you know, as far as Alphabet now as, you know, it was catching a bid in the face of a little bit of softness in Nvidia, which is interesting, and we're seeing the same sort of scenario playing out this morning. I just want to get your take on what you're seeing across the commodities space this morning as well, KG. I did mention that drop in oil that we've seen. We're tracking some reports now, maybe, according to some media outlets, Ukraine agreeing to terms of a peace deal. What are you seeing? What's the impact on the commodity space?
Yeah, so you are seeing oil actually selling off here, trading at around $57.20. We've seen buyers coming in and stepping in around this current level. So let's see if that actually does occur here today. There are early reports that Ukraine has agreed to a peace deal that has been revised from the original one that the U.S. has actually proposed. So I think that's a very key thing for us to really note. In the revision, one of the revisions is actually removing the cap of the amount of troops that Ukraine can have within its military.
Welcome to my channel. Hope you're all doing great today. There's a lot to cover regarding Nvidia, so let's jump right in. Nvidia's CEO Jensen Huang has been busy making headlines during his trip to South Korea. While he was there meeting with major tech companies like Samsung and SK Group, Nvidia's stock actually started moving higher in the pre-market. What grabbed everyone's attention was not only the new partnerships he announced, but also the comments he made publicly for the first time since meeting President Trump. Reporters asked Jensen directly whether the Blackwell chip, Nvidia's most advanced GPU, came up during Trump's discussion with President Xi. Jensen clarified that the chip was not brought up in that conversation. He emphasized that the decision to approve Blackwell sales to China now rests with President Trump alone. Naturally, people wanted to know if losing China sales would hurt Nvidia's current quarter. Jensen explained that it wouldn't. Nvidia already warned investors last earnings call that they expect zero sales to China, and they have completely removed China from their forecast. Despite that, demand from other customers is so overwhelming that Nvidia can still barely keep up. Companies like Amazon, Google, and Microsoft have massive capex plans, over $100 billion combined, spread out across the next 4 to 8 quarters. Those orders alone keep Nvidia fully booked. There was another big concern: are Chinese companies accessing Blackwell chips indirectly through other regions like Singapore or the UAE? Jensen didn't dive into the details, but industry analysts believe some chips do flow through third countries. None of that was discussed in his Korean interviews, though. What really matters is this: Nvidia is locking down huge deals in Korea. Samsung is preparing a new AI megafactory with 50,000 Nvidia GPUs, while SK Group is building one too, and even launching Asia's first industrial AI cloud using Nvidia's RTX Pro. Jensen also talked about the broader impact of AI as he continues expanding partnerships. His message was clear: the overwhelming global demand for AI compute is the real driver behind Nvidia's performance. He also made an interesting comment about China. Jensen believes the Chinese market is huge, vibrant, and home to many talented developers. If Nvidia could legally sell Blackwell chips in China, it would benefit both countries, because AI models built in China are used globally, and having American hardware powering them would strengthen the entire tech ecosystem. He even estimated what China could mean for Nvidia. If fully open today, China could be a $35 to $50 billion per year opportunity for Nvidia, and by the end of the decade it could exceed $100 billion annually. But right now, Nvidia is forecasting zero. They are hoping for non-zero, but planning for zero. And the crazy part? Even with zero China revenue, Nvidia is still breaking records. That shows how enormous demand is outside China. The analysts also pointed out something important: despite Nvidia facing export restrictions and political negotiations, hyperscalers still depend heavily on Nvidia. Why? Because Nvidia offers not just GPUs, but a whole ecosystem: CUDA, software stacks, developer tools, partnerships, and platforms that nobody else can match. During GTC this week, Jensen basically boosted Nvidia's outlook for the next 5 quarters. Analysts said his keynote effectively raised expectations by 15%, and later earnings reports from major tech companies confirmed that picture. Interestingly, Nvidia's stock didn't explode immediately, partly because investors are still trying to wrap their heads around a company worth over $5 trillion. It's a psychological barrier more than a financial one. But many analysts said Nvidia was the hidden winner of the entire week. This week also showed something else: the big tech giants are stronger than ever. Apple's iPhone upgrade cycle is gaining momentum. Google's search business is proving it still has massive staying power. Meta's daily active users continue accelerating, now growing faster for 5 quarters straight. Microsoft's Azure revenue just jumped 40%. And behind all of this? AI infrastructure. Massive capex spending. A race to secure compute. One analyst said we're still on the backstretch of the AI race, not even close to the final phase. Companies like OpenAI, Anthropic, Google, and Meta might take turns leading temporarily, but long-term, there's a lot of racetrack left. This applies not just to software models, but to the hardware side too: Nvidia, AMD, Broadcom, all likely winners for many months ahead. Yes, there will be dips and rotations, maybe even a correction in January because of tax timing, but the long-term trend is very much intact. The spending numbers are insane. Amazon plans to spend $125 billion in 2025. Meta is raising its capex to $70 to $72 billion. Google is spending $91 to $93 billion. Microsoft spent $35 billion in one quarter. These aren't small bets, they're huge commitments, and they point to one clear conclusion: AI capex is accelerating, not slowing. Some people worry that this could become a capex bubble. Even Michael Burry posted a cryptic warning hinting that sometimes the only winning move is not to play. But others argue that this is not a bubble, because demand is real, immediate, and backed by genuine business results happening right now. One panelist said it best: "If you're not a professional short seller, trying to bet against this trend is a terrible idea. This momentum can run for years." To wrap it all together, Nvidia closed the week delivering one of the biggest announcements: a partnership with South Korea to deploy 260,000 Nvidia GPUs across major companies and government infrastructure. Here's the breakdown again. 50,000 plus GPUs for Korea's sovereign AI initiative. 50,000 plus GPUs for Samsung's AI factory. 50,000 plus GPUs for SK Group's AI factory and industrial AI cloud. 50,000 Blackwell GPUs for Hyundai's AI factory. 60,000 plus GPUs for Naver Cloud's AI expansion. This aligns perfectly with what Jensen keeps saying. The world is still massively compute constrained. AI demand is surging. And capacity issues will continue into 2026. This is why Nvidia is such a powerful long-term story. People saying AI is a bubble often ignore that. Every GPU is spoken for. The biggest companies in the world are investing from their own cash flow. There is over $600 billion in combined backlog from Microsoft and Amazon alone. The internet already exists, so AI adoption can scale instantly. Physical AI hasn't even begun its real growth yet. Agentic AI will fuel a second major surge in compute demand. Nvidia has a clear roadmap through 2028, Blackwell Rubin CPX Rubin Ultra Feynman. And Jensen is expecting $3 to $4 trillion in global AI factory build-outs by 2030. This is not what bubbles look like. This is what long-term structural transformation looks like. Bottom line: Nvidia still has a massive runway ahead. And assuming the world continues moving toward agentic AI, physical AI, sovereign AI, and enterprise AI, Nvidia is positioned at the center of it all. Stay long-term, be patient, and avoid emotional decisions. Thanks for watching. Don't forget to like and subscribe. See you in the next video.